Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently some of you have joined the community and that's absolutely wonderful to see. You've asked me a lot of questions about investing in the stock market and what I should do, if you know what you should do, because some of you haven't started yet. You're probably thinking, what should I do? So what I want to do today is I want to give you a portfolio you could potentially start with. So imagine if you had £10,000, right? Or not 10,000, £1,000, even if it doesn't matter, £100, whatever. I want to show you some of the companies you could potentially start with, and I will explain each individual stock as we go along. I will also show you some ETFs that you could potentially add to your portfolios, because the thing is, in the end of the day, some people do not have either the knowledge or the time to look at every single stock they own in their portfolios. As you can see, I've got 30 in this portfolio, right? So these 30 companies I have to research and find out every single month. Okay, when the new earnings report comes out, I go through it, I read it through. So it's quite a bit of a headache to actually keep up with it, but genuinely I enjoy it. But not everybody enjoys that kind of thing. So what I want to do today is just to kind of give you a couple of stocks that you can potentially add to your portfolio or start with, and a couple of companies, ETFs that you could potentially add to. Okay, so let's start with the stocks first. So I've divided into three different sectors. Okay, we've got defensive stocks. So these are stocks that basically no matter what happens, people will still be going to the shops and buy their products. Okay, so companies like Procter & Gamble, Unilever, J&J, Colgate and Hershey, but all of these companies are in the consumer defensive sector. The next one is fast growers. So these are companies that basically are growing really fast. Their earnings are growing really fast. They have basically products that are very much in demand, and they will continue to make money in the basically foreseeable future. The next one is cyclicals. These are companies whose product is not essential. Sometimes is needed, sometimes it's not needed. So for example, companies like Starbucks, for example, not everybody will be buying coffee, right? Not everyone wants to spend £5 or whatever it is, basically when there's no money lying around. When there's a recession, these companies might not do as well as the rest of these companies. But by having these type of companies, what it will do for you is you will have a diversified portfolios. So if we're in a recession, the defensive stock will do really well. The fast growers will still be doing okay, because generally their products that are needed in order to obviously the economy to move forward. The cyclicals, not so much, but again, people will still go to places like Nike and basically buy a couple of shoes here and there for their children. So they will still buy some of the products, but they might not do as well as we expect them. Right, so let's go through each individual stock and then I'll show you some ETFs and then we'll stop the video there. So first company is Procter & Gamble. As you can see, they have a very high PE right now in comparison to the rest of the market. Okay, and in the consumer defensive it's slightly high. So PEs are normally very funny because it depends on the sector, it depends on the company. So you can't just look and then basically say straight away this is overvalued company. As you can see, according to Morningstar, is in fact fairly valued right now. So, and they are growing their business 6% every year in the next 5 years. So first section, we're looking at the stock, then the PE, then the growth, then the valuation from Morningstar. So according to basically Morningstar, you can see right now is fairly valued. Next company we look at is Unilever. Unilever is right now is about 20 PE, 7% growth in the next 5 years. So every single year is expected to grow the earnings about 5%, right? Then basically 14% discounted right now. The next company is J&J. By looking at the PE, it seems very expensive, but normally that's what it trades. If you look at the 5-year average, is around that place. Okay, but right now is expecting 4%. They are doing split the company basically very soon, so we'll see what happens with that. Fairly valued right now, as you can see. Then the next company is Colgate. Colgate, when you look at the PE, it looks really expensive. In fact, I'm not sure if that's true because I'm using a formula. In fact, let me just double check this. Yeah, it looks like that's the correct number, but when you look at the forward PE is actually lower. Forward PE is about 23. So again, you can see it's fairly valued. And finally, Hershey is actually right now 30. The reason every single one of these companies has a higher PE and majority of them are overvalued is because in the last what, 7-8 months right now, if actually last 10 months since the beginning of the year, the stock market has been going down, and obviously people are selling companies in the fast growers and buying more of a defensive stocks because they worry about recession and so on. So that's why probably they went too far, and now they're coming back down again. In fact, I'm starting buying again Procter & Gamble for the first time in almost a year and a bit. I've actually want to buy more of this company because it was overvalued for a long time. So these companies will grow their earnings from 2% to 10%. So nothing too huge. If you can get 7% or more, that's absolutely brilliant. Okay. But normally these companies will be 2%, 3%, 4%. They're low in terms of their basically growth side of things. Now we're looking at companies that are 10 to 25% growth in terms of their overall growth for every single year. Now, Microsoft currently trading 24 PE and 15% growth, expected to grow basically 15% every single year in terms of earnings. 30% discounted right now. Next company is Texas Instrument, another company in the semiconductor, 17.42, 10% growth and fairly valued at the moment. AMD is another company that has been completely, the price I think halved in the last few months. I'm talking about the stock price. But right now, 24, only 24 PE, not bad for AMD, but it's still, obviously, it is quite high if you're looking for that 15 or whatever percent, basically PE. Now, in terms of growth, 25%. And this is one of the reasons why people actually, this PE is quite high, because people are expecting this growth. If the company hits that, basically, then they're willing to pay for that kind of price. That's basically what it means. The fact that this is 24 PE, the people are expecting the company to grow basically 25% or more every single year. And for that reason, they're willing to pay for higher price, so for higher earnings. Okay, more basically, the risk and reward is higher in these companies, if you like. Almost a 50% discounted right now. Next company we have is Visa. Again, another company that has had a 40-50 PE in the last few years, but right now we're looking about 28. So 19% growth expected, and right now 19% discounted, if you like. KLA is another company that I owned in my portfolio. I've basically sold it recently, but a great company. The reason I sold it was nothing to do with the company. It was a lot to do with trying to do the risk, okay, in my portfolio, kind of de-risk and put that money to somewhere else, okay. 14 PE right now and 15, basically 11% growth, 20% discounted right now. So every single company that we're looking at here looks like it's either fairly valued or really discounted. And why? Because all of these companies have been selling like crazy. If you look at some of these companies, literally have lost half of their prices in the last few months. Like companies like Microsoft, AMD, Visa, and KLA really down a lot. Texas Instrument is not as bad as the rest of them. Okay. Now we're looking at cyclicals. These are companies, like I've said before, whose product might not be basically a necessity. So we're looking at UPS. So in terms of delivery, by one of the best companies out there. Right now, only 12 PE, 5% basically growth expectation, and 11% discounted right now. UNP, Union Pacific Corporations, this is a railroad company, one of the best out there, only 18 PE, 12% growth in the next basically 5 years, every single year, fairly valued right now. I genuinely, this is one of my favorite companies in my portfolio. West Management is another great company I would love to own in my portfolio. As you can see, they have a high PE. They've been going up and up. I think it's like right now is 170. I sold it, I think, when it was like 140, hoping that it will come back down. It just kept going up. Now 15% growth expected every single year in the next 5 years, but 25% premium right now. Nike is another company that lost half of its value in the last few months and only 23 PE. And I say only 23 because this company had almost a 30 plus PE not long ago. 5% growth expected and 30% right now discounted. And next company is Starbucks. Starbucks is one of those companies where it also lost quite a bit because of the union situation, because of the rest of the markets going down as well. So 24 PE, 7% growth expectation, and 14% discounted. Now, what we're doing here is we're saying basically 60% of your portfolio should be this. Okay, These companies you see should be 6% of your overall total portfolio. And you don't have to own every single one of these companies that I've given you here today. If you're sitting there thinking, okay, I might actually look into these companies, please do so, okay? And if you're really interested in any of these companies, make sure you do your proper research and do not rely on just this, okay? Because like I said at the beginning, I'm not a financial advisor, but I'm just kind of giving you an idea where you should start. Okay, this is the kind of video genuinely I would have liked to see when I started investing, because it would have helped a lot. So these defensive stocks, you might say, okay, I'm gonna buy 2 of these companies, okay, maybe just put 100 in each one of these companies, and another 2 and another 2 from here. So you got 6 companies, and then you can add some ETFs to kind of de-risk the whole thing. So 60% for me, 60% is good. However, if you're starting and you don't have the time, you don't have the knowledge, or you're thinking, you know what, I'm not going to get a lot of time to look at these things, then I will tell you right now, you should be about 30 to 40%, no more than that when it comes to individual stocks. And then the rest of the time, you can look into, these are not the only ETFs, that are basically the 40% remaining, or the rest of them, you should maybe look at these ETFs, okay? These are the 3 ETFs that I think are okay, and they have a low expense ratio into comparison, and some of the companies in these ETFs are actually quite good. Now, starting with these 2 companies, basically, okay, this is the world, and then this is the US version. Both of them are iShares. Now, the problem with this, and I've shared this bit with you before, I've sold this one here, the US version, because look at this. These 2 companies are the same. Look, the top holdings are identical. The only time they actually differ is this bit here. But again, DHR is actually there, and then Abbott Laboratories is still there, Cisco is there, CRM is the only difference, and Shell. These are the 2 stocks that they are different when it comes to the top 10. And the top 10 is quite heavy as well. So what I would say to you guys is, maybe pick one of these 2 companies. But if you want normally a lot more exposure to the US and a lot more exposure to Europe and other companies, or basically around the world, then maybe it's not bad to hold both of them if you are not buying a lot of individual stocks. Okay, then we've got the Invesco Dow Jones Islamic Global Developer and Developed Markets ETF, and the top 10 is Apple, Microsoft, Amazon, Tesla. And I think this is done by the market weighting. So this is basically the S&P 500. The biggest company in the S&P 500 is Apple, then Microsoft, then Amazon and Tesla, and then so on, so Google, and so on. So each one of these companies is basically, obviously, you know them, and they are by far the best, right? So this ETFs is really interesting. And the expense ratio, I think it is, let me quickly check because I was looking at it not long ago, 0.40%. So it's really interesting to see that it tracks the S&P 500 more or less, and at the same time is Sharia compliant, okay? And you've got that, and you've got these basically other ETFs that you could potentially add to your portfolio. So you can make even this 60% of your overall portfolio, and then 40% here, or even maybe if you don't want that risk, 20% in stocks and then 80% in these ETFs. It's entirely up to you how you want to structure it. But the point I'm trying to make here is that right now is a great time to get into the market, because a lot of these companies are really down, right? Number 1. Number 2, if you want to invest in the stock market, the reasons we like to invest in the stock market is because when you look at the S&P 500, okay, it returns at least 7% every single year for basically years and years. That's on average. Some years obviously it will go sideways, and some years will have basically give you a negative return, but on average in 10 years, 20 years period of time, you will average about at least 7%. Now 7% is better than basically putting your money into, I don't know, in your savings account, leaving it there and get basically inflation basically eat your money alive. Obviously it's better than that. And if you are scared and you're not too sure what to buy right now, maybe look into these ETFs, and you don't know much about stocks, and go for it. But one thing I would advise you not to do is basically just copy this as it is and then say, you know what, I'm done for now I'm going to invest in these companies. Although they're great companies, you need to look at their financials, their forecast, and you need to look at basically their revenue. You need to look at what they've said in their latest earnings report to see if there's any problems, anything that's coming up soon that you might need to look into. So anyway, I want to share with you guys basically this part here. As you can see, this company, basically ETF, seems really interesting. If you would like me to do a full video on this, let me know. There's not much to it, to be honest with you. The expense ratio we already know. In terms of dividend, they don't pay any dividends right now. In terms of risk and so on, it looks like it tracks the S&P 500. So it'll be interesting to see what else basically we can learn about this ETF. I've done a full analysis long time ago, so I haven't done one recently. So if you want me to look into that one, just let me know and I will look into it as well. Anyway, I hope you enjoyed the video, and if you are enjoying the video, I would absolutely love if you can give it a like. And obviously, if you once you're happy with this and you've got some hopefully you've done your research, then you can go into, for example, Trading 212, and you can search for these ETFs as well as the stocks that we talked about today. Every single one of these stocks and every single one of these ETFs you can actually buy in here. And the one thing I would definitely encourage you to do is have an ISA account. Okay, if you live in the UK, definitely get an ISA account. Stocks and shares ISA account, not normal accounts with this company if you want to, or any other company you want, because that will save you a lot of money in terms of taxes and so on. Okay, I hope you enjoyed the video. Have a wonderful day. Assalamu Alaikum.